Did you know there's a market worth over $1 trillion that impacts your mortgage, your job, your investments, and even the price of crypto? Most people don't understand how this market works or even what it is. No, it's not the stock market, and it's not Bitcoin. It's the bond market, and it's the most important piece of the global financial system. So what exactly is a bond? Picture this: you're starting a business. You've got a brilliant idea, a bulletproof plan, tons of energy and passion. But there's one problem: you don't have the money to get started. What do? You borrow from someone who does have the money, and you make them a promise. You'll not only pay them back, but you'll give them a little extra on top. That extra is called interest. People and businesses borrow money all the time, but here's something you might not know: governments borrow money too. When a company or government needs to borrow, they do it by issuing bonds. This makes them the borrower, or the issuer, and the investor becomes the lender. Think about everything governments spend money on: infrastructure, military, healthcare, education. But here's the thing: government spending has a secondary benefit. It stimulates the economy by creating jobs and making citizens and businesses more productive. And productive citizens and businesses? They generate tax revenues, which is where most of the government's money comes from. Take a look at the UK government's revenue sources. The vast majority comes from taxes. In fact, only about 11% comes from non-tax sources. But here's where it gets interesting. Governments tend to spend far more than they collect in revenues. That gap between spending and income is called the budget deficit. Every year governments spend more than they collect. They're adding to the total national debt, the cumulative amount owed from all past borrowing. As of 2025, the UK's national debt sits at £2.7 trillion. The US national debt? A staggering $36.7 trillion. Let that sink in for a moment. So where does all this extra money come from? The government borrows it from the public by issuing bonds. When the government needs funds, the Treasury holds auctions, selling bonds to investors from around the world. These bonds are typically bought by banks, insurance companies, pension funds, foreign governments, and yes, even regular people like you and me. Why do investors buy bonds? Because US government bonds are considered some of the safest investments in the world. If the UK and especially the US were ever to default on their debt, meaning they went bankrupt and couldn't repay it, well, that would essentially be the end of civilization as we know it. If that ever happened, we'd have much bigger problems to worry about. Let me break down some key terms you'll hear when people talk about bonds. The principal is the amount being invested or borrowed. The coupon is the interest payment, expressed as a percentage you'll receive on that bond annually. The maturity refers to when the loan is due, or how long until the investor gets their money back. And the yield? That's the actual return the investor gets from the bond. Now, here's where it gets a bit tricky. The yield is different from the coupon because the price of the bond can change, affecting the actual return. You see, while the bond's price fluctuates, the coupon, the percentage payment, always stays the same. This means the yield can change based on the bond's price, which is constantly shifting. When the bond price falls, the yield rises. When the bond price rises, the yield falls. It's an inverse relationship. So how are these bond prices determined? The government sells bonds in treasury auctions on a set schedule, weekly or monthly, depending on the maturity. The yield at auction depends on how much demand there is for these bonds at that particular time. This is called the primary market. When new treasury bonds are sold in the primary market, the yield becomes a benchmark. Investors in the secondary market then look to this price to reassess the value of similar bonds already in circulation. In the secondary market, investors are constantly buying and selling bonds based on what they think will happen to rates. They're making educated guesses about whether rates will go up or down, if the economy will speed up or slow down, if inflation will rise or fall. These questions determine what yield makes sense for them to lend money at. What this means is that market interest rates are really just the yield that global bond investors are demanding at any given moment. It's all based on their expectations for the future. When market rates go up, the cost for the government to borrow also goes up, and the interest the government pays on its debt increases too. Remember that $36.7 trillion in US government debt I mentioned? Well, not only does the government have to pay that back, but they have to pay it back with interest. The interest payments alone are currently around $3 billion per day. Yes, per day. This makes market rates incredibly important because they determine whether interest payments are going up or down. Right now, a lot of government debt is in short-term treasury bills, which constantly reset because they mature in relatively short time frames, 6 months, 12 months, or 18 months. The government continuously uses these short-term treasuries to fund borrowing, a process called rolling over the debt. As a result, the overall debt burden keeps climbing, and more of the country's GDP has to be spent servicing this debt and paying the interest. This means the government has less money available for essential services like healthcare, infrastructure, social programs, and military defense. Unless, of course, they keep borrowing more to cover the debt burden, which, unfortunately, is exactly what they're doing. To pay for public services while also servicing their debt and interest, they're taking on more and more debt, compounding the problem for future generations. So how does all this affect the stock market? As I mentioned earlier, bonds are considered very safe investments because unless the US government defaults, it has to pay back your bond with the agreed-upon interest. Stocks, on the other hand, are much riskier. A stock represents a small piece of ownership in a company, so if that company's stock price plummets for any reason, your investment plummets right along with it. If an investor has to choose between a 5% bond that's guaranteed to pay them back and a stock of the same value that's considerably riskier, the wiser, safer choice is the bond. The interest rate for government bonds is called the risk-free rate. The difference between the expected return from the stock market and the interest rate from government bonds is called the equity risk premium, or ERP. When bond yields rise, that premium shrinks, and investors start selling stocks because they become less attractive compared to bonds. It's a delicate balance that affects trillions of dollars in investments. There's a similar concept within the bond market itself. There's a crucial difference between government bonds and corporate bonds. Government bonds are issued by governments, while corporate bonds are issued by companies. Government bonds are much safer since it's highly unlikely a government will default on its debt. Companies, however, are more likely to default because they can go bankrupt. When there's more fear in the market, investors demand higher interest rates from corporate bonds since the investment feels riskier. The gap between safe government bonds and riskier corporate bonds is called the high-yield spread. When that spread widens, it's usually a warning sign that there's trouble brewing in the markets. Here's the thing, the bond market isn't just a mirror reflecting the economy, it actively shapes it. As interest rates rise, they slow down the entire economy. Higher rates make it more expensive for businesses to borrow and expand, for people to buy homes, and for consumers to make big purchases. It creates a ripple effect that touches every corner of economic life. Understanding the bond market gives you insight into one of the most powerful forces in global finance. It affects everything from your mortgage rate to your retirement savings, from the value of your investments to the stability of entire economies. The next time you hear about bond yields or treasury auctions in the news, you'll know exactly why everyone's paying attention. This isn't just abstract finance. This is the machinery that drives the modern world.